Let's turn back to the real-life impact of tariffs on retailers across the country. Anisha Sherman from Bernstein is with us for more on that. Anisha, how do you expect this to play out? And are this discussion about whether store shelves could be empty and so forth, is that scaremongering or is that realistic?
Yeah, it's important to remember that before we saw the orders drop off, we saw a big pull forward in orders from China. From November through January, U.S. retailers and brands were calling up their China suppliers and asking them to produce more ahead of tariffs. And that inventory landed in the U.S. from January to March. So we've seen strong double-digit inventory growth year to date. Usually it's flat year over year. So we've seen a pretty big pull forward. And so now we are seeing a big drop off in orders, China orders in April and likely in May as well. TEOs leaving China dropped 35% in April. So we're seeing some big drop offs, but it's on the back of this pull forward. So I don't think we will see shortages just yet. I think it's more just a normalization in response to the tariffs. But yeah, I mean, I think if this level of ordering continues, if we do see continued canceled sailings and canceled orders, then we should start to see a tightening in the supply. But it's also important to understand demand is decelerating too. So it's not all else being equal. Demand is slowing down, which means inventory is going to last longer.
Right. It's sort of a weird thing. Like the shelves won't be that empty because no one's buying anything. You know, it's kind of a worst of both worlds scenario. When you see shops like Apollo saying that they expect a recession mid-year because they think there's going to be layoffs in trucking and layoffs in retail, does that jive with what you're hearing from the companies you cover? Or do you think that there might be a more sanguine outcome?
I think so far we aren't there yet, but I do think that if we continue on this path of demand decelerating, prices going up, as you just showed, Shein, Temu, some of the other online sellers are already raising prices. That's going to continue from sellers that are very over-indexed to China production. And tightening in supply is just going to drive prices up higher, which is then going to drop off in demand. So I think if we continue down this path, it is a likely scenario that we'll see at least a mild recession, depending on kind of the magnitude of it. But I think if tariffs are alleviated or if there's some other injections, such as a tax cut, et cetera, that could change the scenario significantly.
I'm sure there are people who want to avoid the retail sector for the next few months, but maybe it's priced in some of this. You have a few names. TJX, I mean, that obviously comes up because they can benefit from inventory bleed. Tapestry, On. What's the story with On? They've seen a number of notes that are much more constructive on them.
Yeah, I think for both Tapestry and On, I mean, generally the framework I look at is you want to be long names that have low income exposure or more high income exposed, because that consumer is going to be more resilient and less likely to cut back spending right away. You want to be invested in names that have pricing power. So if there is, if the tariff scenario ends up staying the way it is, or perhaps even getting worse, they're able to pass on some of that pricing without really impacting volume. And you want to be in names where the product is resonating, it's compelling, we don't have a bunch of inventory issues. People want the product, because that's what people are going to spend on. As they're starting to make choices, they're going to cut back on basics and they're lean in on products that are very compelling. So Tapestry and On both check the box for all of these three criteria. And so I think they will be more resilient than the rest of the discretionary goods sector in the next few months.
Yeah, I know On, there was a lot of concern about that Vietnam supply chain. Maybe that is, alleviated at the margin for now. What does it mean when you say all else equal, more expensive inventory equals increased demand for velocity? What does that mean from the supply chain point of view?
Yeah, I mean, from a supply chain perspective, what it means is rates are going up, supply is tightening. And so it means that there is a lower demand for product, a lower demand for shipping routes and for carrier routes. And so that might actually affect downward trend in rates. And as you said, some layoffs in the trucking industry, which again causes consumer implications in terms of demand. There's unemployment going up across the industry. That's going to turn around and impact demand for goods. So all of this is very much linked.